Stocks rose Friday as investors received mixed reports on the state of the U.S. labor market. With the back-to-back misses on the monthly payroll gains, the policymakers will want to keep the current support system in place for longer. The unemployment rate fell to a new pandemic-era low of 5.9%, and this came at the same time as a drop in the labor force participation rate. Both indicate a smaller share of Americans out of work return to the labor force to look for or take new jobs. Investors may interpret the miss in job gains as a sign that the economy has not yet recovered enough to warrant a pivot in the federal accommodative monetary policy. And they'd be right. What we seem to be experiencing right now, whether you believe it or not, is a not too hot and a not too cold economy with that gradual opening happening. In my opinion, this will keep the market climbing the wall of worry, and that's good for investors. So, with that, let's take a look at the charts. And today we're going to take a look at one chart, the 6-month daily on the spiders, the SPY, and the close on Friday was 422.60. Going back here to the lower left portion of the chart, we can see more or less the bottom channel line moving through like that, and then the top channel line moving through more or less like that. So in the market, this is not too hot, and this is not too cold. And we've been moving through this for several months, and I think it's not going to be anything different coming here into the future. We had a bit of a hesitation, as you can see here, and we called that out last week. Now we came down, bounced off of that 20 EMA, but doesn't have much of a bounce to it yet, and we'll see that here in the MAC when we get to that. First, volume. Volume looks fine. Nothing wrong with that. Now here into the MAC. So from this point here, we had a move, a hesitation with a little bit of a drawdown. And then from that point here, we did accelerate and headed on up to that point here. So we had the bottom at this level here, but you can see that we're not quite accelerating yet as much as I would like to see. So this hesitation does remind me a little bit of this hesitation back here. It looks a little bit different, but basically the same thing. Some hesitation here, so hopefully we'll work through that by next week and the week after. Here in the histogram, you can see the same thing. We did come a long way from that bottom up to here, but we've had this more or less sideways trade here in the histogram that's showing the hesitation in the market. So hopefully we'll kick out of that next week, the week after. Price rate of change looks okay. Nice bottoming here, but again, needs to continue to climb up there into that overbought territory, which is above that 20, as we did back here in mid-April. Moving down, and you can see here, this also tells the story. We are only at a 65.67 in the RSI, and that's just moderate. We did have that bottom here, and we have climbed, so there is improvement, but we need to move up and out through here into that overbought territory, which is in that 80 or above level, as again back here in April. Moving here into stochastics, looks okay. It is moving through into that overbought territory, and so is the Williams. And these often lead, the Williams often leads from that low here all the way on up here. So I think that is going to foretell what's going to happen in the other oscillators. I think we'll get to that overbought territory soon enough, and that's going to be the maximum strength. And hopefully that will also take this price chart and move those prices at least to the upper level of that channel line. Now, it may take into next week and perhaps the week after, but I think at least that's the probability now of where we're heading. So, once again, just be vigilant and be patient. And for today, that's ChewDog Charts. Thank you.